Welcome back to the Advocate Insurance Desk. I'm Katie Dowson.
And I'm Grace Schmidt.
So, Grace, March Madness has just kicked off, and our office, everyone at Advocate, everyone around us, all our friends are getting pretty excited. So, brackets dropped, everyone's locked in. I think it would be doing our listeners a disservice to not do a March Madness Rivals themed episode. I mean, we are a sports podcast after all.
Right, 100% a sports podcast. But I also couldn't agree more. And so obviously for this episode, I had to wear my team's gear because my team, University of Missouri, Go Tigers, is in March Madness this year. So it was only right that I rep them. But like in basketball, there are some insurance markets that have some rivalries. And the best rivalries are the ones where both sides genuinely think they have the edge. So let's take a true blue blood basketball rivalry, Duke versus UConn, and look at how their respective states' insurance markets stack up against one another. I want to see which one, North Carolina or Connecticut, is actually winning right now and why.
Yes, me too. So when we pool North Carolina and Connecticut multifamily package pricing, the gap between them is real. Even though the trajectories are moving in the same direction, the reasons behind the numbers are very different. And actually, before we jump in, if you're new here, just quick thing to know, this show is built around the Advocate Market Terminal, our insurance intelligence platform. Every episode, we're pooling real data, real carrier behavior, real premiums. We're not doing market outlooks or general commentary here. We're showing you what's actually happening.
And the reason why market data is so important is that most people in this industry are flying blind. You get your policy renewal and you have no idea if the premium you've been quoted is good, bad, or somewhere in between. And that's why Advocate has built the Bloomberg for insurance, to bring price transparency to an already opaque market. And on this show, we bring you the insights of the terminal directly to you.
Okay, Grace, let's start with the scoreboard, or what the terminal calls the trading tab. So for those who are new here, the trading tab on the market terminal shows state, city, and peril-specific indices updated in real time. Each index reflects the current pricing sentiment across policies in that market, giving you a snapshot of how underwriters are pricing risk right now. The banner running at the bottom of your screen shows the changes for each indice the day the episode is posted. But back to today's state matchup. What does the terminal show us about where North Carolina and Connecticut are sitting in terms of multifamily package pricing, Grace?
So when we pull the multifamily package index for both states, here's where we land. North Carolina is at $13.45 for its rate online, which for anyone new, the ROL, or the rate online, is the cost to buy $1,000 in coverage. So North Carolina is at $13.45 and Connecticut is at $15.81, which puts Connecticut package pricing about 17% higher than North Carolina right now. However, and this is important, when we look at the one-year trend, the measure the movement, North Carolina has actually appreciated 18.15% over the last year, compared to Connecticut, which has only appreciated 16.12%.
Wow, so North Carolina is catching up, closing that scoreboard gap because of its higher appreciation percentage.
Yes, Connecticut came in as the expensive market player today, and the trend shows that it is actually only getting more expensive. But North Carolina, which did look like the value player here, is actually appreciating at a higher rate.
So North Carolina is the cheaper market today, but it's getting more expensive quite quickly. That spread is closing. But the reasons behind that movement are completely different from what's driving Connecticut. And that's exactly what we want to get into. Because when you understand the risk environment of each of these states and what they're operating in right now, the drivers behind their pricing divergence start to make a lot more sense. So let's start with their risk environments. North Carolina, what do we know, Grace?
Yeah, so North Carolina is host to major wind hail events. I mean, just last week on March 16th, 3 tornadoes touched down in North Carolina, 1 in Charlotte and 2 in Madison County, which is in the western part of the state.
So what do we see in terms of wind hail coverage down there?
Yeah, so when we look at the wind and hail coverage data inside of the terminal for North Carolina multifamily policies, it tells you that wind hail isn't a coverage that operators are electing. It's essentially assumed. Carriers are building that wind and hail risk right into the base structure of every policy they write here.
So when the terminal is showing us North Carolina package pricing increasing by 18% over the past year, we should put that appreciation within the context of a market that has been through Hurricane Helene, a historic flooding event in the western part of the state that exposed a massive coverage gap, and now severe connective storm activity showing up again this week.
That's right. And that environment is one of the areas that separates North Carolina from Connecticut. So when we do look at Connecticut now, we will see a completely different story. While the terminal shows that Connecticut is running about 17% more expensive than North Carolina right now on an absolute basis, the 1-year appreciation rate is actually slightly lower.
And why is that? How should our listeners make sense of the higher price but lower appreciation rate?
Connecticut is what I'd call a steady state, low competition, but expensive market. The risks, nor'easters, aging buildings, limited carrier availability, none of these are new. They've been baked into pricing for years. So you see a high floor, but not a lot of movement. Whereas when we look at North Carolina, it is in a repricing cycle right now. Helene, the tornadoes this week, these rising convective storm frequency, carriers are adjusting in real time. And that's why you're seeing an 18% appreciation. It's not even that North Carolina is riskier than Connecticut overall. It's just that the market is catching up to risk that wasn't fully priced before.
So far, the picture that the terminal is painting is this. Two markets, both moving up, but driven by completely different environmental forces. North Carolina is being repriced by an accelerating storm environment, while Connecticut is being held at a structurally elevated price point because of its coastal geography. So that's the ground level picture for each state. Now, the question is, when you actually run the data in the terminal, what specific variables are doing the pricing work? Because weather is the backdrop, but the factor analysis is going to show us something that is much more precise in this.
Let's get into it.
Okay, pulling up the market terminal now, we're going to show what's actually impacting the price in each peer set and by how much, starting with North Carolina.
So in North Carolina, the single biggest pricing driver is RCV of structure, which adds about 15.1% on top of the base rate. That is the dominant factor by a wide margin. Annual gross rent comes next, which adds another 5.3% to your base rate. Carrier selection adds about 2%, whereas product type pulls it down by 3.3%, and your build also pulls it down by 1.6%.
So in North Carolina, the size of your asset, as measured by replacement cost, is the thing that is working against you the most. The bigger the building, the higher the pricing penalty.
Exactly. And that makes complete sense when you think about what's happening in the bigger picture of North Carolina right now. Tons of people are moving to the state, and larger, newer assets are being built in the metro regions like Charlotte, Raleigh, or Durham. These builds have higher replacement costs, and underwriters are pricing that concentration risk. So the more expensive a building is to rebuild, the more a carrier stands to lose on a single event, whether that's a hurricane on a coast or a hail event inland. And with the tornadoes touching down in Charlotte just last week, that risk isn't hypothetical anymore.
Got it. So that's North Carolina. And what have we found in Connecticut?
So Connecticut is a completely different ballgame. The single biggest pricing driver in Connecticut is not asset size, it's region, measured by zip code prefix. That factor alone is adding 9.2% on top of the base rate. Year built adds 2.9%, and RCV of structure, which was the dominant upward factor in North Carolina, is actually pulling down the base rate in Connecticut by 0.8%.
So in Connecticut, where your building sits within the state is the thing that matters the most, not exactly how big the building is.
Right, 100%. And that is a direct reflection of the coastal geography we just talked about. A building in Fairfield County on the Sound is fundamentally different underwriting conversation than a building in Hartford. The zip code prefix factor is the market's way of pricing that coastal concentration into every policy.
So let me take a crack at a coaching staff analogy here.
Oh boy.
So in North Carolina, the game plan is about managing your asset size, but in Connecticut, it's about managing your location, two completely different strategic problems.
So that was a stretch of a coaching analogy, but
Something?
it was something. But yes, if you're an investor running a portfolio across both states, you need two completely different underwriting frameworks.
Okay.
What works in Raleigh is not going to be what works in Hartford.
See, that's what I was going for. And you can see all of that in the per door numbers, because when you translate those factor differences into actual dollars, the gap between those two markets is striking. So let's look at that.
This is the number that I think should stop every investor in their tracks. So the average premium per door in North Carolina is $703, whereas the average premium per door in Connecticut is $1,335.
Wow. Okay. So Connecticut owners are paying nearly double per unit.
Nearly double. So on a 100-unit building, that is a quick back of the envelope math, that is a $63,200 difference in annual insurance expense. And that affects what you can actually pay for an asset and still hit your return targets.
This is, I think, a moment that we just need to stop because this is exactly why the terminal matters for underwriting decisions and not just renewals. So, if you're modeling a deal in Connecticut and you're using a national average for your insurance expense, you are underwriting with the wrong number. You need to be looking at the average for your specific peer set. Okay, let's talk about who is actually writing this risk because when we look at the carriers in each of these states in the terminal, the rosters look completely different lineups, Grace.
100% completely different rosters. Connecticut is a traveler's market, full stop. When we pull the carrier data in the terminal for Connecticut multifamily, the top 3 carriers by rate online are all travelers entities. Travelers Casualty and Surety at $2.71, Travelers Indemnity at $3.31, and Standard Fire Insurance, which, don't worry, is also a part of the Travelers family at $3.38.
Wow, so one carrier family is dominating the top of the Connecticut market.
Yes, and that tells you something really important about the structure of this market. Travelers is headquartered in Hartford, so this is their home state, this is their home turf, their home court advantage, and the terminal reflects that. They're writing more of this business than anyone else in Connecticut, which means if Travelers has a change in appetite, tightens their underwriting guidelines, or starts repricing the book, Connecticut multifamily owners will feel that shock everywhere at the same time, and it's only exacerbated by the lack of alternative carriers competing at the same price point.
And we can actually see what that concentration risk looks like in practice when we compare to the North Carolina carriers.
Totally. So flip it to North Carolina, and the carrier landscape is completely different. Top carriers in the terminal are Bankers Insurance, which have a rate online of $1.06,
Nice.
Lloyd with a rate online of $1.51, and Milford Casualty at $1.89. So it's a much more fragmented market, much more competitive at the bottom of the pricing range than compared with Connecticut.
And those ROLs are dramatically lower than what we're seeing in Connecticut, with Travelers at $2.71 compared to Bankers at $1.06.
And it circles directly back to the factor analysis we discussed earlier. In North Carolina, the carrier selection factor is adding 2% to your pricing, meaning the right carrier relationship genuinely moves the needle. Whereas in a fragmented market with real price competition at the bottom, the terminal shows you exactly which carriers are writing at which price points, which means your broker does not need to shop blindly.
This is the contrast I keep coming to. 2 states, 2 completely different carrier markets, 2 completely different strategic playbooks. And the terminal is what makes both of these playbooks visible. And that visibility matters when you're making the acquisition decision in the first place, not just looking at your renewals. So let's talk about what this looks like for a buyer. Grace, if you're underwriting a deal in North Carolina or Connecticut right now, what do you need to know from an insurance lens before you close?
This is a question I think that doesn't get asked early enough because sometimes insurance just gets treated as a closing checklist item, and it really shouldn't be. It should be in your underwriting model from day one, from the jump.
So let's start with North Carolina. You're looking at a deal there. How can the terminal help me?
Yep. First thing, pull up the comp set for your asset in the terminal before you model your insurance expense. Because what we just showed you is that RCB of structure is the single biggest pricing driver in North Carolina, adding 15.1% to your base rate. So if you're buying a newer garden-style mid-rise in Raleigh or Charlotte, your replacement cost is going to be high, and the terminal is going to show you exactly what comparable assets are paying today. So don't model your insurance expense off of a deal you did 3 years ago in Charlotte. No, pull up the current comp set for that metro area for your specific location.
Okay, Connecticut. We have a listener that's looking at a deal there. How can they use the terminal to help them?
First thing, again, is pulling up the comp set for your asset. We know the zip code where your asset sits is the single biggest pricing factor in Connecticut, adding 9.2% to the base rate. And the terminal makes that visible at the asset level. So a building in Fairfield County on the shoreline is going to sit in a completely different pricing tier than a building in Hartford. So pull up the comp set for both and look at the regional factor impact side by side. The gap is material, and it goes directly into your NOI model.
That is pretty concrete advice, Grace. I think it's time now to bring it on home and tell our listeners what are the key takeaways that they should walk away with from this episode. What should they know?
So 3 things. First, the terminal is telling us that North Carolina and Connecticut are moving in the same direction, but at different speeds and for completely different reasons.
Hmm.
North Carolina appreciated 18.15% over the past year, whereas Connecticut appreciated 16.12%. So North Carolina is closing the gap on an already more expensive market. So if you're underwriting a 5-year hold in North Carolina, that trajectory is not a 1-year anomaly. Second, the factor analysis is showing us that RCV of structure is the dominant upward driver in North Carolina, adding 15.1% to the base rate. As long as new high replacement cost assets keep being built in Charlotte and Raleigh, that factor is not going away.
And what does the Connecticut side of the equation look like? Can you remind us about that?
Yeah. So in Connecticut, the terminal is showing us that zip code is your biggest pricing variable, adding 9.2% to the base rate. That factor does not move, right? You can't renovate your way out of a coastal geography. So the structural pricing floor in Connecticut is going to remain pretty elevated regardless of the broader market. Third, the carrier market in these two states is not interchangeable, and the terminal makes that visible. In Connecticut, Travelers dominates. The rate online data shows that their syndicates are riding at $2.71, $3.31, and $3.38. So pretty much Travelers is the market in Connecticut. That concentration means limited competition at the bottom. So when we look at North Carolina, on the other hand, the carrier spread in pricing is much wider. Bankers Insurance is pricing at $1.06, which is much lower than the broader market. And that gap is real, and it's capturable if your broker is putting your submission in front of the right carriers. So those would be my 3 takeaways.
And I actually have a fourth that I want every investor and operator to listen to and act on. The factor analysis tool in the terminal doesn't just tell you where your premium lands, it tells you why. And knowing why is where the leverage lives. In North Carolina, your RCV is working against you, 15.1% upward pressure. In Connecticut, your zip code is working against you, 9.2% upward pressure. You got a lot of people working against you in this game, okay? And those are not abstract market forces. Those are specific variables you can account for in your underwriting model, your submission strategy, and your renewal timing. The operators who are walking into renewals with that visibility are the ones that are having completely different conversations compared to the people who are just accepting whatever number comes back.
I think that fourth takeaway really pulls the full picture of this episode together.
Thank you, Grace.
The risk environment tells you why these markets are priced the way they are, and the factor analysis tells you exactly what is moving your number and by how much. You need both. One without the other is an incomplete playbook.
So, Grace, who is winning this matchup? I think it's time you show us your bracket.
So, outside of my bracket, obviously claiming University of Missouri as number 1. But on price today, North Carolina wins. So Duke is winning this matchup. Lower cost per door, more carrier competition, and more room to optimize. But Connecticut is a more established market. The risk profile is more predictable. And if you know how to navigate the geography, you can absolutely still build a strong program there.
Knowing your premium is one thing, but knowing what's driving it and which state you're playing in is where the leverage actually lives in the terminal.
And for any of our listeners who want to see their own market through this lens, a different state, a different asset class, we'd love for you to check out the market terminal yourself. That's what the platform was built for.
Grace, thank you so much for doing this one with me. I loved showing our sporty side.
It was pretty fun. I mean, a little March Madness, a little insurance data. What more could our listeners want?
Nothing. So yeah, thank you to everyone for listening. I hope you got what you came for. We will see you in the next episode. This has been
the Advocate Insurance Desk.